Here's a question nobody asks enough. What happens when a company has a pile of cash and absolutely no idea what to do with it? The answer, historically, is stock buybacks, the corporate equivalent of burning money in your backyard and calling it returning value to shareholders. Today, we're going to look at three companies, three philosophies, three very different outcomes, and by the end, you'll understand why Treasury discipline might be the most underrated edge in all of finance. Let's get into it. Our three characters: IBM, the cautionary tale, $200 billion, lit on fire, slowly, over 25 years. While executives cash checks, Berkshire Hathaway, the gold standard, Warren Buffett sitting on $390 billion in cash and T-bills, doing absolutely nothing with it until the perfect moment. Strategy, the wild card. Michael Saylor converting every dollar he can raise into Bitcoin, building what might be the largest liquid treasury asset on the planet. Three companies, three answers to the same question: what do you do with capital? Let's start with IBM, because honestly, this story is almost funny. Almost. From 1995 to 2019, IBM spent $201 billion buying back its own stock. That's not a typo. $201 billion. 25 consecutive years of buybacks. Three CEOs ran this playbook. Lou Gerstner, $44 billion. Sam Palmisano, $99 billion. Ginni Rometty, $58 billion. And here's what they got for it: absolutely nothing. IBM's market cap actually dropped 40% from its 1999 level. The stock was about $120 in the year 2000. 20 years later, about $130. 2 decades, $200 billion. The stock moved $10. Meanwhile, the S&P 500 tripled. Now here's where it gets spicy. Why would a company spend $200 billion on something that clearly isn't working? Charlie Munger, Buffett's partner, the guy who probably understood incentives better than anyone alive, said it plainly: show me the incentive and I'll show you the outcome. IBM's CEO compensation was tied to earnings per share, EPS. And here's the dirty secret about stock buybacks: they mechanically inflate EPS even when your business is shrinking. You don't have to grow revenue, you don't have to innovate, you don't have to do anything useful, just reduce the share count, and magic, earnings per share goes up. So that's exactly what they did. Revenue declined for 22 consecutive quarters under Rometty. 22. That's 5.5 years of shrinking. And in the middle of that streak, in 2016, Rometty got a 65% raise, $32.7 million. Oh, and the best part? While IBM was buying back 67 million shares per year, they were quietly issuing 18 million shares per year back to executives as stock-based compensation. So a quarter of the buyback was just going back into management's pockets. The shareholders funded it, the executives pocketed it. The stock went nowhere. That's not capital allocation. That's a heist in a nice suit. The lesson here isn't that buybacks are always bad. Apple's buyback program actually worked, but Apple was also growing revenue, dominating markets, and buying at reasonable valuations. The lesson is, buybacks as a substitute for strategy are a red flag. When a company's primary use of capital is buying its own stock while the business decays, what you're really watching is management choosing their bonus over the company's future. IBM could have used that $200 billion to lead cloud computing. They could have owned AI 5 years earlier. They could have acquired companies, built products, hired the best engineers in the world. Instead, they chose the path that maximized executive comp with minimum accountability. Show me the incentive. I'll show you the outcome. Now let's look at the opposite end of the spectrum. Warren Buffett is sitting on $390 billion, cash and treasury bills, doing nothing. And the market thinks that's boring. Why won't he deploy it? People ask. Why is he just sitting there? Because he understands something most CEOs don't. Liquidity is power. Cash isn't dead money when you have the discipline to wait for the right moment. Berkshire didn't become a trillion-dollar empire by being aggressive. It became one by being patient. When markets break, 2008, 2020, whenever the next one comes, Buffett has the ammunition to buy whatever he wants at whatever price he sets. He's not begging banks for credit lines. He's not issuing emergency shares at the bottom. He's the one writing the checks while everyone else is panicking. That treasury isn't boring. It's a loaded weapon waiting for its moment. Notice the contrast with IBM. Both companies had access to enormous capital. But Berkshire's philosophy is preserve optionality. Don't spend unless the opportunity is extraordinary. Buffett pays himself $100,000 a year. His wealth comes from owning the stock, same as any shareholder. His incentives and your incentives are the same. Incentive alignment, that's the whole game. So now we come to strategy. And this is where it gets interesting, because strategy isn't doing what IBM did, and it isn't doing what Berkshire does either. It's something new. Michael Saylor's thesis is simple. Instead of hoarding fiat cash that loses purchasing power every year, convert it into the hardest, most liquid monetary asset available, Bitcoin. Strategy has raised capital through common stock issuance, convertible notes, and now STRC, a preferred security that pays a dividend to investors while strategy uses the proceeds to buy Bitcoin. Current stack, over 568,000 BTC. Cost basis around 33 billion. Current value north of 60 billion and growing. But here's what most people miss. This isn't a trade. It's not buy Bitcoin and hope it goes up. It's a capital accumulation system. And here's the key. Most people get this wrong. STRC does not have a fixed interest rate that requires refinancing. Strategy controls the dividend rate. They can adjust it monthly via formula. There's no refinancing event, no maturity wall. The capital market access risk that bears worry about, much smaller than it appears. The math works like this. If strategy raises preferred capital at 10 to 11% and Bitcoin compounds at 20, 25, 30%, the spread between cost of capital and return on asset is the value creation engine. That spread widens over time. The preferred obligation is fixed in dollars. Bitcoin is not. Think of it like this. Imagine you could borrow money at 10% and buy real estate that appreciates at 25% a year. Every year, your asset gets further ahead of your liability. That's essentially what strategy is doing, except the asset is more liquid than real estate, has no tenants, no property taxes, no maintenance, and no zoning boards. It has volatility. That's real, but it doesn't have toilets. Now let's talk about where this goes if it works. If strategy eventually raises $100 billion through STRC, that's not just a $100 billion obligation. It's also $100 billion worth of Bitcoin purchases. At an average price between $80,000 and $125,000, that's $800,000 to $1.25 million additional BTC. Added to the current stack, strategy could end up holding 1.6 to 2 million Bitcoin. 2 million Bitcoin. Let that breathe for a second. At $500,000 per Bitcoin, that's a $1 trillion liquid treasury. At $1 million per coin, $2 trillion. We're not talking about a leveraged bet anymore. We're talking about the largest single-entity treasury on Earth. But lucky, you say, what about the $100 billion in STRC they owe? Great question. And this is where Saylor's optionality becomes beautiful. He's got 3 levers to retire STRC, and he doesn't need all 3. Any one works. Lever 1, slow the dividend. Strategy controls the STRC dividend rate. They could lower it gradually, 50 to 75 basis points at a time. As yield drops, yield seekers rotate out. Price dips. Strategy buys back STRC at a discount. Self-reinforcing loop. Do this over 3 to 5 years. Lever 2, sell a small slice of Bitcoin. If strategy holds 2 million BTC and Bitcoin is at 500,000, selling just 10%, 200,000 coins, raises $100 billion. That's enough to retire the entire STRC stack while keeping 1.8 million BTC. Lever 3, issue common stock at premium valuations. If strategy holds 2 million BTC at 500,000, the common stock could trade at 3,700 to 5,000 plus per share. Issuing a small amount of common at those prices to retire preferred is massively accretive to remaining shareholders. 3 levers, no corner, pure optionality. Let me show you the math on that stock price. Right now, MSTR trades around $178 at roughly 1.2 times its Bitcoin NAV. It's been as high as 2.8. It's been as low as 0.97. In the future scenario, 2 million BTC at 500,000 at 1.5 times NAV with 400 million shares, 3,750 per share. At 2 times NAV, 5,000 per share. at 2.5 times NAV with 350 million shares, over 7,000 per share. And here's why a premium makes sense at that scale. At 2 million Bitcoin, Strategy is Bitcoin infrastructure. It's the single largest liquid Bitcoin vehicle on the planet. That commands a premium the same way Berkshire commands a premium over its book value. The key variable is share dilution. If most of the Bitcoin accumulation is funded by STRC, which is preferred, non-dilutive to common, the share count doesn't balloon. That's the elegance of the structure. So let's zoom out. 3 companies, 3 philosophies, 3 outcomes. IBM spent $201 billion buying back stock while the business shrank. Stock went nowhere for 20 years. Executives got rich, shareholders got nothing. The incentive was EPS manipulation for compensation. Berkshire preserved $390 billion in cash and T-bills, built a trillion-dollar empire through patience, discipline, and crisis buying power. Buffett aligned his incentives with shareholders by owning the stock and paying himself $100,000. Strategy is converting fiat capital into Bitcoin, using common equity, convertibles, and STRC to build what could become the largest liquid treasury on Earth. Saylor aligns incentives by owning massive common stock. The through line? Incentive alignment and treasury discipline are everything. IBM proves what happens without them. Berkshire proves what happens with them in the fiat world. Strategy is betting it can prove what happens with them in the Bitcoin world. Here's the thing most investors miss. They evaluate companies based on revenue, products, employees, customers, traditional metrics. But those same things create risk. Customer churn, competitive pressure, AI disruption, margin compression, lawsuits, regulation. A company with 10,000 employees, 5 product lines, and 100 enterprise customers might look safer than Strategy, but it carries a dozen hidden fragilities that compound over time. Strategy has exactly one question. Does Bitcoin continue to monetize globally? That's a concentrated bet. No doubt. But it's a simple bet on a clear thesis with aligned incentives and multiple exit strategies. Sometimes simpler is better. Sometimes the company with no customers, no products, and no employees, but a trillion-dollar liquid treasury, has more optionality than anyone. Now here's the part that should make you uncomfortable. You might be thinking, okay, IBM was bad, one company, bad management, lesson learned. But IBM isn't the outlier. IBM is the default setting of corporate America. In 2024, S&P 500 companies spent a record $942.5 billion on stock buybacks. Forecast for 2025, $1.2 trillion. Over 85% of the S&P 500, that's 435 companies, did buybacks that year. They're doing this while the Shiller-Cape ratio sits at 40, 2.5 times the historical median of 16. They're buying back stock at the most expensive valuations in modern history. And roughly 16% of all buyback spending isn't even real shareholder return. It's just offsetting the shares companies handed to executives as stock-based compensation. Of the top 20 buyback programs in the post-2009 bull market, only 5 outperformed the S&P 500 over a decade. 15 out of 20 would have been better off doing literally nothing. So think about what this means for the average index fund investor. Every dollar you put into an S&P 500 index fund buys a tiny piece of 435 companies running some version of the IBM playbook. Buying back stock at record high multiples, offsetting executive dilution, hitting compensation targets, calling it capital allocation. You think you're safely diversified. But what you're actually diversified into is hundreds of slow-motion capital bonfires. Companies spending nearly $1 trillion a year to buy their own stock at 30-40 times earnings, while their CEOs collect bonuses for hitting EPS targets that the buybacks mechanically inflate. That's not investing. That's a hamster wheel dressed up in a suit. Berkshire doesn't do it. Strategy doesn't do it. And maybe that's why both of them, in very different ways, are building something that actually lasts. So let's bring it home. Berkshire was the greatest fiat-era capital allocator because it used cash, float, patience, and discipline. Strategy is attempting to become the first great Bitcoin-era capital allocator by using capital markets, preferred securities, and the hardest monetary asset ever created. One built a fortress out of dollars. The other is building one out of Bitcoin. Different eras. Same principle. The Treasury isn't just a line on the balance sheet. It is the strategy. IBM spent $200 billion and went nowhere. 87% of the S&P 500 is doing some version of the same thing right now, and most investors don't even know they're along for that ride. Now, here's what's coming next. Starting next week, we're launching a new series on this channel. We're calling it Levels of Jackassery. Every week, we're going to take a company that's roughly the same market cap as strategy, a company that Wall Street considers safe, diversified, proven, and we're going to break down every single hidden risk they carry. The real estate exposure, the customer churn, the executive compensation games, the buyback bonfires, all of it. Then we're going to compare their capital allocation to strategies. Same size, same market cap, wildly different philosophies. And you can decide for yourself which one looks like the better bet over the next decade. First up, a $72 billion public safety company that spent $17 billion on buybacks, borrowed so aggressively they went negative on equity, and trades at 31 times earnings. Same size as strategy, very different choices. Should be fun. I'm Lucky. Thanks for watching. See you next week. And if you're still in the index fund hamster wheel, well, now you know what you're buying.